Hi there, welcome to kneppyinvests. In this Appendix 4C video, I'm going to talk about one of the best named companies on the ASX, and that is Dragontail Systems. This is not a company that hunts dragons for their tails. This is something completely different. In fact, they are a quick service restaurant tech provider. I'm not sure why they have a name called Dragontail, but if you want to argue with me that this is not the best named company on the ASX, we will have an argument, and I will win that argument, without doubt. Otherwise, before we get into their Appendix 4C, let's have a look at a few facts around this company. Dragontail Systems is an Israeli company originally. I'm not sure if they would consider themselves still an Israeli company, but they listed on the ASX in late 2016, probably, I think, if I remember correctly, December of that year. I'm not sure why Israeli companies listing on the ASX, but there is a few of those sort of companies that have done that. So there probably is some benefit for Israeli companies and American companies and other companies from other countries to list on our market. I'm not sure what that reasoning is, but there's definitely is some benefits. Market cap of Dragontail is 64 million. And when you look at the revenue and operational cash flow over the past 12 months, I think the market is pricing in some good growth over the next few years for this company, because revenue is only $1.9 million and operational cash flow negative 4.5, and the price to sales ratio at current prices is 33.7. So definitely the market, based off that ratio, is pricing good growth over the next few years. If you want to have a further look at this company, and I do highly recommend having or doing a bit more research in this company, they do look interesting on first glance. So they released their Appendix 4C on the 20th of April. So let's have a look at their most recent Appendix 4C to see if maybe their cash receipts are going up and that revenue of $1.9 million in a year is a little bit low based off their growth rates. Whenever a company releases their Appendix 4C, I go straight to the consolidated statement of cash flows and I look at section 1. So I skip all their activities. I don't really care what the company has done over the past 3 months. I want to know what the numbers show me. And then if I like the numbers, I might read the activities. So let's go straight to the cash flows from operating activities. And there are 2 numbers I like to look at here. And then if those numbers interest me, I'll have a look at some of the other numbers. So receipts from customers for Dragontail over the past quarter was $675 US. So they report in American dollars. So that doesn't seem that high, particularly when you look at research and development, which was $700,000, product manufacturing operating costs $686,000, but staff costs only $253,000. So the receipts right now aren't not even covering research and development or even product manufacturing and operating costs. So they are burning through a bit of cash. In fact, over the past quarter, they burned through $1.3 million just in their operating activities, which means because they're burning cash, they will have to do capital raisings. And funnily enough, they actually did do a capital raising during the past quarter. It was a $5.5 million capital raising, which increased their cash on hand from $2.2 million to $6.4 million. So at least they have enough cash on hand for, it looks, at least the next year based off the cash burn rates in this quarter. But you never know, the cash burn rates might increase. And even if they do increase, maybe the receipts from customers will increase as well. So when you look at the receipts from customers in isolation, that means nothing. You need to know some sort of growth rate there or a trend. Is receipts growing or are they going backwards? So we'll have a look at that in the next slide. Since Dragontail Systems IPO'd in late 2016, we do have receipts history going back to January 2017. And in that quarter, they only had $9,000 in receipts. So you would expect any company to have grown receipts from then. If they hadn't grown receipts, that would be highly negative. One thing that you do see here, particularly during 2018 into 2019, receipts were quite lumpy. You can see massive growth in receipts from July 2018, 112,000, to October 2018, 356,000. Then it dropped to 163,000 in January 2019, and then it shot up to 449,000 in the next quarter. So the overall trend was up, but fairly lumpy in the growth rate. And then we saw receipts pull back in 2019 and the start of 2020. So if I was a Dragontail investor at that point, I would be getting a little bit nervous because you don't want to see receipts going backwards. You want to see it going forward. And it does seem, and I'm just hypothesizing here, that Dragontail was a beneficiary of COVID-19 because their clients are quick service restaurants. So a lot of takeout during lockdowns. And so there would have been a lot of companies wanting to use Dragontail, their products, their technology. And that's probably maybe a reason why receipts have shot up for Dragontail from 200,000 in April 2020 to current receipts of 675,000. So it's tripled in a year, but still not a lot, 675,000. But if they continue that sort of growth rate for the next year, by April 2022, we might see receipts heading towards 2 million. And if they can get receipts for 2 million and keep control of their costs, we might see this company heading towards becoming operational cash flow positive, and that would be a significant inflection point for this company. But right now, with the valuation of the company, I think the market is thinking that's what might happen to this company in the future. Finally, just going to look at some charts for Dragontail. The first chart we'll look at is the 3-year weekly chart. So really ignoring the first year they were on the ASX, but the share price of Dragontail was dropping prior to that. So it fell all the way to about 10 cents by late 2019. Then we did see the shares in Dragontail trade between a range of about 15 cents and 7 cents. So 15 cents was a resistance level, 7 cents was a support. You don't really see this company being, if their share price being affected by COVID-19. Maybe a small hit, but it reached about 7 cents in March 2020. But the main thing you want to see here, when a company's shares are trading within a range, you want to see a breakout of the share price through resistance on really good volume. And actually, we'll look at that in the next slide because there was a breakout in the share price in early 2021. And from there, the share price has gone higher. Final thing for this video is to show you the 1-year daily chart for Dragontail. Nothing much was happening with this company from May 2020 to January 21 when things started to turn around. In fact, when the share price whenever it got to about 16 cents during that period of time, the share price or the shares pulled back. So that was a resistance level. And when you see a resistance level, what you want to see is a breakout of the share price on good volume. And we saw that happen on the 22nd of January. Now, about 8 days before that day, the company released their Appendix 4C. And in my opinion, that was the catalyst behind the re-rating and the development of a new uptrend in the share price for this company. When the shares moved through that resistance level, in fact, on that day, the share price increased 30% on the 22nd of January. The company also received a price query from the ASX trying to understand why the shares had increased quite substantially. So the share price or the shares of Dragontail moved through that resistance and resistance became support. So any time for the next 2 months, any time the share price got to 16 cents would have been a good time to buy in because that was a very good support level. And you can see it hitting 16 cents on numerous times over the next or subsequent 2 months. It wasn't until early April when the shares took off again. In fact, the shares went from 17 cents to a high of about 23.5 cents. So we do have a developing uptrend you can draw in right there. So if that uptrend maintains, I'd be maintaining a holding in this company. And if that uptrend fails, that's when you might consider selling out. That is all I've got for this video on the Appendix 4C for the best named company on the ASX. That is Dragontail Systems. If you completely disagree with me about my search and this is the best name on the ASX, leave a comment in the comment section. Give me some alternatives. I love to hear what is your favorite named company on the ASX. If you have a serious question or comment, make sure you leave that as well. I'll try to answer anything you have to say as soon as possible. Otherwise, I'm not a financial advisor, so if you do need financial advice about your own circumstances, make sure you speak up to a professional or someone who is qualified and who can help and speak to your own financial circumstances. That's all for this video. Have a good day. See you later. Bye.